All right, good afternoon, everybody. You've got him, Kevin Graham, Schwab Network. Kevin, well, you're back from the holidays, man. How are you?
Doing pretty good. Look, we actually had 70 degrees here in Denver for Christmas, and I think that actually broke a record. So we're doing pretty decent. We did actually get some snow yesterday, but it's been a pretty decent break and been kind of slow on the market front. You know, it's kind of these range bound days, a little bit boring. Volatility's crushed, but still fun. How about yourself? How was your holiday?
I mean, if you're talking about fun and volatility and being quiet, I mean, you can't say that without talking about silver and the metals, man. It's been absolutely nuts, right?
Yeah, silver trade has been crazy, and obviously today we did see a pullback here. But I just want to sometimes, Stephen, you know this, when we have these type of cycle moves, there's a lot of new traders that kind of get into the trade because they are momentum traders, and rightfully so.
Yeah,
Uh, but you have to also kind of have a little bit of context. And I think days like what we saw last week are a little bit out of the norm when it comes to silver. Days like
yeah,
today, even to the downside, is a little bit out of the norm, especially if you're very new to this market. But it is a commodity, and volatility spikes like we have seen, and volatility can be both to the upside as well as to the downside. They can last in these commodity markets for a relatively long time before it subsides. So this is not for the faint at heart at all. I think has been a fundamental story that has been out there. And you guys are going to hear this on news channels all the time and things of that nature. But I'll give you the quick rundown. You have the central bank buying pressures. You do have industrial demand, especially when it comes to renewable energy projects and solar panels and things of that nature. You have China potentially going to restrict silver exports in
yeah.
2026. I think the market was also pricing in that maybe a full-on ban can happen as well.
Mm,
What has not been really covered that much, though, Stephen, is China just sent over to the LME a significant amount of silver about 2 weeks ago, 3 weeks ago. And if you kind of look at that alignment of the physical transfer and the push that we saw to the upside, it does make a lot of sense. LME inventories are moving to the downside. Delivery notices are increasing. China inventory levels for silver is relatively low. China, the major producer and smelter of silver as well. So
yeah.
this like metals paper trade to physical trade type of rotation continues to happen throughout 2025. Started off with gold, then we saw it within copper. You're seeing it in silver right now. And maybe we did have a blow off top here today. That might be the case. Who knows? Maybe it's a consolidation and we run higher here. But I wouldn't, if a day like today made you a little bit uneasy because you were on the long side, then your size is probably too large for what
Yeah.
might be coming up here.
And some people I heard on Twitter was talking about like, oh well, it's manipulated because the CME decided to raise margin requirements.
Yeah.
That's normal. I mean, when the price goes like that, that's what's normal to happen. It's not manipulation. That's just what happens, right?
Yeah, exactly. Yeah. So that's actually a really good point. If we want to break that down here really quickly, because I think there's always this conspiracy that comes out when margin requirements are increased by the CME. It's kind of like whenever we have volatility that's really high, repo markets are being leveraged and utilized, and then somebody sees that the Fed has this random meeting on their schedule. But the Fed actually does meet every single month. People don't know that. They actually do have
Yeah.
supervisory meetings every single month. But anytime that we see any type of volatility, people say, oh, this is the emergency meeting. It's the same thing with the CME. The CME changes its margin requirements on products on a day-by-day basis.
Daily
Right?
basis. Yeah, that's right.
They have a baseline of volatility levels. They'll usually use a historic average. And when a contract goes outside of those volatility bands and sustains that for, let's say, 2 weeks, 3 weeks or so, then they start to increase those margin requirements in order to protect themselves as traders. And so, yes, the raising of those margin requirements could force individuals to kind of sell out of a position. But we have to be mindful too, margin requirements, they go both ways, not only on the longs, but also the shorts. I think the new margin requirement that was put out there is like 25,000 or whatever for the bigs.
Yeah.
You're probably is going to have more than just the CME baseline margin requirement that's standard within the industry. But if I wanted to go long, I had to pay 25,000. If I wanted to go short, guess what I also have to do? I got to put up 25,000. So is it going to dampen and maybe pull back a little bit because of that? That could be the case.
Sure.
But I just had a podcast the other day and I said, and this is abundantly true in any type of commodity, if a commodity wants to move higher, The CME is not going to be able to stop that.
We'll stop it. That's right.
And so it's not a conspiracy. That's what happens. You get the weekends, everybody starts posting charts, and I was.
Well, I mean, on Friday I did call the top. I said, "This is it. This is nuts. I mean, this is the end of it, right?" And some people go, "Oh no, we're going to $100 an ounce on silver." I mean, we've seen this a million times where silver explodes. We saw it in the '70s, and it never recovered for 50 years, right? I think we're seeing it again, right? So I don't know. I think that the nonsense is happening. All right, let's get to it. My friend Jay Wood said 7,300 on the S&P. I said 7,500 by the end of next year on the S&P. You had some thoughts on the S&P, right?
Yeah, I mean, I can't give a price target. Right. So you're saying 70. You said what's your target?
7,500.
All right, so you're looking at what, around 14-15%, give or take, move to the upside.
About 15%.
Yeah. About 15%. Okay. I'm doing that off the top of my head. What's actually very interesting is mid-teen estimates when it comes to the rate of return on the S&P 500 over the last couple of years have actually been the low ball shot. Actually, if you kind of look at it, you're looking at around the 20%, give or take, move to the upside for the S&P 500. So I'd say you probably are in line with what we've seen over the last 2 years, 3 years or so. But I always go back and say, when you look at analyst expectations, and I'm not trying to be super bullish for next year, I'm going to be honest with you. I think we're going to have a good, there's a lot of people that say we're not going to have a good first half and then the second half is going to be great. I think it's going to be opposite. I think we're going to have a situation where we're going to see a lot of strength, especially in the economic data in the first half of next year. And then we actually do see a pretty deep pullback. I don't know how we're going to finish the remainder of the year, but we could see a potentially deep pullback. But analysts are 80% of the time are usually lower than what the market actually does.
Right.
So if you say 15%, historically speaking, the market is probably going to be higher than that. So you can take the consensus estimate and kind of add another couple of percent to it, and that's usually where the mark is. And Stephen, the reason why I say, hey, we might have some tailwinds to start off, some headwinds. The economic data right now looks great. It's not the best data set. I'm going to be honest with you. I'm not going to say I don't believe the numbers. The numbers are the numbers, but I think that there's a lack of data in these reports that are kind of showing some outliers within, let's say, GDP, on both sides of GDP, not only just the GDP number itself, but also the inflationary, the PCE component of GDP was also completely outsized. I think that's going to continue in January, February, March. The recovery from the shutdown is going to take a lot. And then the other tailwind that you're going to have at the beginning of the year, which is why I don't think it's going to be as bad, is that you will have more liquidity hitting the market. Tax receipts, people are already talking about that, right? Bigger tax refunds, that's going to spark consumer spending. You're also going to see a pay down in consumer debt as well. Usually that happens in March and April. Financials usually report really well and around that May period because of that drawdown in debt. They have a little bit more cash on hand. They deploy capital. You have the rate cut environment. Mortgage rates looks like they're trying to stabilize, at least for now. Even if they do stay at the levels that they are at right now, housing prices are coming in, especially some of the very high demand areas. They're starting to see declines. We have a year-over-year decline here in Denver, and that's the first time that that's actually happened since I moved out here. So I think that actually gives you a little bit more tailwinds. Economic data looking favorable. I don't think it's actually favorable, but looking favorable. And then the liquidity that's going to be coming into the market. And then I think the back half of next year looks a little bit ugly, especially leading up to the midterms. Now, one of the sectors that I do think could actually outperform next year is the energy sector. And I don't like to say that too lightly, because the oil market itself is still not looking that great from a demand standpoint, and there are supply fears, but that might be priced in for now. I think you probably could get one of these flushes to the downside to around $45, $42 for WTI. And I think it's going to be really brief and quick, and then I think you see a reversal. But the reason why I bring up the energy sector, if you look at the XLE, and that's the chart I provided, this is going back into 1990. Now, let's talk about the candle structure at the top. The candle structure at the top, this is a monthly chart, and I love monthly charts because the longer time frame that you come out, the clearer the trend. Now, this one kind of says, hey, you had to move to the upside, but it looks like a topping pattern. You had higher lows at some point in time. Now we're making lower highs, right? maybe it's a consolidation. You could call it a flag if you want to. I don't think that would be quite the case because once again, we haven't made new highs for the XLE. RSI, let's say it's not looking that great, but at the bottom there, we have a MACD. This is a monthly chart. And you can look at the past monthly MACD bull crosses. Each and every one of them resulted in a minimum of an 18% move to the upside within that year, within 365 days at a minimum. And Stephen, a lot of those moves are actually a lot greater than that. On average, it looks like around 28 to 30% or so. I did this back of the hand math before going on the network today. But we're about to potentially see another bull cross within the energy sector here. Once again, next 365 days, you could be up around 18%. That has been the average since 1999. So this could be a sector that does actually do fairly well. I kind of go back on that, I won't say bear thesis, but good at the first half, maybe a little bit difficult or bearish in the second half of next year, because Stephen, energy outperforming, or not even outperforming, let's just, if I told you that energy next year could potentially do 18, let's even say 20% next year, do you think that's a good thing or a bad thing for the broader equity market?
Well, I think it's a bad thing because it's pulling money out of the markets and it's costing us. Obviously, for gasoline, it'll cost more for gasoline and transportation. Blah blah blah. It's a whole macro thing. So I agree with you. And I can't talk. And energy is a Trump thing. So I mean, he loves oil. He loves the oil and gas industry. So I've said that the first half of the year is going to be hot. The second half of the year might be just all about the election and who's winning in the midterms. Okay, I can't talk to you about not talking about Powell. A few minutes ago, Trump just said he is looking to replace Powell by January, and he said something very interesting. He is looking to sue Jay Powell for gross negligence. Now, I've heard a lot out of the president over the last year. I won't say the S word, but that one might be top of my list right now. Can a president sue a Jay Powell?
I
don't know the answer to that one.
Okay, I don't know that because he said, so maybe that's how like the news has kind of cleaned up what he said, because I saw it live.
Okay.
He said gross
negligence, right? No, gross negligence, right?
For gross incompetence.
Incompetence. Oh my God.
It wasn't even negligence, right? And I'm like, oh, I don't know how you still do that for a Fed member, but okay. But he said for gross incompetence.
Okay.
And I've never actually heard of any type of lawsuit like that. But I think he's just kind of, he's blowing off some steam. He knows.
Should we look at Kalshi and Polymarket and see what the chances of Powell making it past January?
I think they're going to keep. It would be. I think that he knows that. I think Scott Bessent has definitely told him, "Look, let this run its course here." I don't think Powell is going to stay. I know that there's this outlier that he might actually stay on in order to protect the integrity of the Fed. I mean, we'll see if that actually happens. Look. If you actually look at Powell's setup leaving the Fed, he actually looks pretty good.
He does.
If you go back and look at 10 years from now and you look back and you say, okay, how did Powell do? You would probably say, if you didn't know, he did okay. I mean, look, at the end of the day, inflation has been sticky, but it has gone to the downside. Equity markets still are making new all-time highs. Hasn't been a massive blowout when it comes to the yield market in general. Right. And he still is trying to keep integrity for the Fed. The dollar did move to the downside last year, or this year, if you will, but that was going to be the case anyway with economic data being fairly weak, and the dollar was actually relatively strong to other currencies, especially the euro, for a fairly long time. So yeah. I think if you go back, I mean, you and I, we're talking about it now. Everybody knows the ins and outs and purple ties and the comments that he made. But if you look at it in 10 years from now, we're going to look back and say, you know what, he wasn't that bad. And he's going to end on a high note. And he knows that he's going to be able to get the hell out of Dodge.
Kevin, I mean, I'm glad there was an adult. Finally, you have an adult that's speaking up. I mean,
yeah.
But the chances of him staying are not very high.
Yeah, but even the Fed chair is only one person. So they
True.
can't dictate
But
policy.
Mirren has come in. You've got 3 replacements already, so and then he'll
Yeah.
get the 4th one, right? So he's getting, and I think it's a slap across the bow, saying, "Hey, if you don't do my bidding, I'm going to kick your butt out," right?
Yeah, I mean, we all know that that's taking place here. But at the end of the day, the Fed terms for these members that outlast any presidency, especially
Yeah,
this president.
yeah.
So they're going to do as much as they possibly can, and maybe sway towards the policy that he wants. But I think they also want to protect their legacy because they know that they're going to stay in there a lot longer. So I think it probably will be a headwind when it comes to yields, especially on the long end of the curve, 10, 20s, and 30s next year. I still think actually could still move higher here. I would not be surprised if we saw a 5 handle
Yeah, I mean,
on the
we're looking
10-year
at
next year.
4.114 on the 10-year, and the 30-year pushing out to
Yeah.
November of 2055 is at 4.799. So the yield curve is nothing, right?
I mean, the spread on it actually is the most healthy spread that we've seen in a very long time on a
Exactly.
relative basis.
Very
I don't
healthy.
I don't see where you get more of that spread, though. I think that's kind of you and I are probably talking about that, right? Where else can you squeeze out the juice out of this orange? And I'm not sure if it's going to be on the short end of the curve, 'cause, right? The short end, the 2 year is not going to disconnect too much from Fed funds at all. Right, unless something like materially breaks in our markets.
And
So
new housing starts jumped to 3%, right? So we're starting to see a little bit of even the housing.
low base, man. I mean, the housing data has been like not that great.
Yeah.
It hasn't been that great. So it's like looking at the mortgage applications. If I gave you the mortgage application data and you looked at it on a year-over-year basis, you would think that we were in a housing boom right now. I think
Yeah.
if you're looking at year over year, I think mortgage applications increased by like 60%, 65%. But if you're actually looking at it on a nominal basis, it's not really a massive uptick when it comes to purchases in
Right.
new home builds or even existing homes for that
Well,
matter.
I think it's supply, right? There's not much supply on the market, correct?
It's coming. It's coming though. The supply on existing inventory is hitting the market, and the thing to note is that it's not all homes, right? Single family home supply is hitting the market. If you're looking at multifamily homes, that has already been in a recession and a glut for like the last 2 years, 3 years or so. If you're looking at it on a national basis, but single homes are being brought to the market. We are hitting the highest cancellation rates that we have seen in over 2.5 years, 3 years, pretty much since COVID-19. You're seeing a lot of bids being pulled from this market. So there's individuals getting off of the sidelines, but we are starting to see a glut. You are starting to see prices move to the downside here. I think that's your biggest tailwind that you have for inflation next year is the OER. But I think you get some headwinds when it comes to services inflation as well as goods inflation. And if we actually do see the cycle of crude oil bottoming, let's say it hits 45 next year, early on next year, bottoms and then rips higher, geopolitical risk, logistic risk, I think that's going to be a problem. Gasoline is already relatively cheap, so they have a very low base there. Year-over-year comps are going to be very difficult this time next year. We know that as well. And then you're looking at food prices, which a lot of the agricultural commodities out there are still trading at very depressed levels at this point. Once again, year-over-year comps are going to be very difficult. So it's on the horizon that we probably will see stickier inflation on the goods front the second half of next year anyway.
Yeah, you talk about geopolitical issues. I mean, you got China, Russia, Ukraine, Poland, Turkey, believe it or not. Now Iran is an issue where the rial in Iran has hit the lowest against the dollar, I think, in history now, where Iranians aren't even opening up their businesses. They're right now in the streets screaming and yelling. Israel's a problem right now. Somaliland, China and Taiwan, China and Russia. I mean, what in the world? Have you ever seen this much, or is it just social media pushing all this narrative?
No, it's definitely ramping up. You are seeing a readjustment in the world, right?
Yeah.
You did see about a month ago, the White House released their national strategic review, if you will, right? Their strategy. And I don't know if you read it, and I'll send you the link, Stephen, because you should definitely read it. It's interesting. You could tell that it wasn't a career individual that actually wrote that piece. It's their national security strategy, and they completely revamped it. So they're looking at hemispheric influence, Western Hemisphere and removing themselves from Europe and East Asia, which is a little bit of a different change a lot different change in policy. Actually, that policy is kind of going back to what the 40s, 50s. So we're seeing a massive readjustment, realignment here. And I think aligned with that is where these geopolitical risk events are coming into play. I think one of the bigger risks that you have next year also is this metals war. I talked about this yesterday on a different podcast. But I think the fact that commodities, we could see protectionism across all commodities in the next year, that is a risk that I think grows bigger and bigger on a day-by-day basis. That means we just talked about silver not coming out of China potentially, right?
Yeah,
That's
I was getting ready to ask
risk.
how it's affected with China cutting down and stopping their exports as well. And for those of you who don't know what Kevin's talking about, that link I put up there for you of the National Security Strategy right out of the WhiteHouse.gov page. Click on the link there to understand what he's talking about. But yeah, you got to talk about from China's standpoint, shutting all exports of silver down, right?
Yeah. And other metals and minerals. I think we are, the market kind of looks at the China situation and say, hey, we already have our trade deal, we're done. That's not the case. It was only a temporary reprieve until the next round here. And I think if you kind of look at it, China pulling silver away is a really big deal, because silver is in 90% of all electronics. We need it just as much as for defense, just as much as we need other metals. So I think that's a problem. And then you have the mining issues that we are seeing pretty much across the globe. And so do we see a pullback in the metals space? Does South America actually also escalate? And then when you're looking at South America, you're then talking about what, lithium, but then you're talking about the softs. You're talking about the agricultural markets. Then you're talking about soybeans, corn, you're talking about cattle, hogs. So there's a lot that's actually going to be readjusted here. And I'm not saying that this is going to happen, but you can kind of see some of this writing on the wall, where I think that people need to keep their eye out on certain items. Putting 25% of our naval fleet in the Caribbean, Stephen, to take over or topple Maduro is not normal at all, right? There's probably a bigger play that's there. We also know that there's this Panama Canal dispute between the U.S. and China as well. We're trying to purchase it. They're trying to kind of restrict the purchase in some respects. Now we have assets that are near that. So there's a lot that's going on. I'm not saying that all hell's going to break loose next year, but the geopolitical events that are out there, I think still should be in the back of everybody's mind. It could be a vol event, and some of it could actually lead to a pretty significant cycle, or even a super cycle within the commodity space.
And I'm going to pull up
it's dangerous.
Yeah, I'm going to pull up a screen of wheat prices, WEAT, for those of you if you're just playing the ETF side of it. The wheat fund is pretty much, if you look at a daily chart here, there's a weekly chart. I mean, it is at an all-time low. I mean, wheat prices are just astronomically down to the bottom side. So, I mean, if anything's affected by Russian wheat's probably one of the biggest, right? If you're looking at it from the perspective of corn, same thing. There's these corn here, pretty low, 450, for that the bushels there. So pretty cheap stuff here, and yeah, I mean, but if anything hits any of that, inflation goes right back to it. I appreciate that. Yeah, that's a very good point there. All right, Kevin, did you have a good holiday? Everybody's good, and
everything else is good. Everything else is good, man. Look, I just kind of advise people, take the next week or so. Markets get a little bit choppy and you don't feel like trading. Now is the time to read up and get the market research for next year. There's a lot of investment banks that have free reports, like really good 40, 50-page reports out there about the markets. And you can get everybody's different perspectives, a lot of free knowledge that is out there. That's what I usually do, Stephen. Last 2 weeks of the year, I study up. And then on a week-over-week basis, I then find one topic or two topics, hone in on it. But this is kind of my whole big refresh, and I would advise people to do the same.
And I just got my Jeffrey Stock Traders Almanac for the year. He signed mine up in New York for me. I agree, but is there any points that you would like to? Any place we should go to get that free data? Any place that you like right now that we should go get data from?
Yeah, I mean, obviously, if you look at Schwab, I love it. A really good one as well. But I also want to make it so it's not biased as well. ING Commodities, if you just search that on Google, they actually have a really good report. It's like a 70-page report, goes through the commodities. They also have it for other markets as well. ING, they kind of focus more on the European markets, but they do have U.S. equity focus. JP Morgan, their report, I haven't read that yet, but I just printed that out yesterday as well. And then I always like to read the Goldman Sachs commodity report. I usually read a lot of commodity reports. I'm not so much in the equities because I'm a big believer that commodities, right, raw goods, will lead into 90% of whatever else is being traded out there, no matter if it's technology, communication services, they all still revolve around physical goods as well as softs. So I like those reports out there.
I'm pulling those reports up. I agree with you, especially the Goldman Sachs report. I have thrown that one actually into GPTs as well, about 15 GPTs to understand the Goldman Sachs outlook. That's a very good one. Of course, ING, I like the ING report too, but this one here, the Goldman Sachs report, that's a great report. That report right there, shove that into GPTs if you need to, so that you understand what's being said. There's a lot of charts, a lot of understanding. So yeah, I appreciate that. There's the link for that too. All right, Kevin, we'll see you right back here next week, my man.
I appreciate you. Have a good one.